All right, let's start with Altair. Altair, welcome to the show. How are you?
I'm great. Thank you, Mike. How's everything with you?
My pleasure. I'm good. I'm doing really good. Tell me about your background. Let our audience get a feel for you, and then let's drive into at least let's start with the book that you wrote and talk about the other things, tax cuts, Jobs Act, and things of that nature.
Sure. I've been in this business since 1982, and I have several partners with me right now. And we have a comprehensive financial planning business in Fairfield, New Jersey, that deals with everything from business planning, individual planning, retirement planning, etc. I wrote this book about a year ago, and it's been an idea that I had for many, many years. And it all started with, playing a couple of rounds of golf, which I started later in life, unlike many people, and, quickly realizing that after playing, various sports, basketball, baseball, etc., I always thought golf would be my ride into the sunset, because it was probably a pretty easy game. Nobody's trying to hit you. Nobody's blocking your shot. Nobody's throwing a 90-mile-an-hour fastball at you. And I quickly realized it's probably one of the most humbling games of all. It's you and this little white ball, and gosh, you just can't get it to do what you want it to do all the time.
Got it. Now, Tax Cuts, Jobs Act, how it impacts individuals and, if you will, corporations who employ those individuals.
Yeah, I mean, I think if you look at the Tax Act, as far as individuals go, we've done a couple of analytics already in our office, and it's interesting. We did an analytic for a single woman making about $150,000 a year and living in New Jersey, and she was going to come out paying about $2,000 more. We did the same analytic for a business owner, married filing joint, and they were going to come out paying probably $2,000 or $3,000 less. So the few analytics that we've gone through already, it's leaning towards people will save money in taxes. The problem that you have in high tax states like New Jersey, New York, Connecticut, California is that we're losing the deductibility, since it's capped at $10,000, for property tax, state and local income tax, et cetera. And these states have very high property taxes and very high state taxes. So there's a disadvantage in those states for some people, for sure.
Okay. What about New Year resolution financial planning? Where are we going with that?
New Year's resolutions. I got to tell you, the resolution that most people have is, the same one that they have individually, which is I want to lose 20 pounds. Okay, the reality is in financial planning, most individuals want to get their financial house in order. And in order to get their house in order, they have to take a step back, take a look at where they are today, where they want to be down the road, and then develop those strategies and implement those strategies, and more importantly, follow through with those strategies on how they're going to get there. Somebody once told me not too long ago, they're doing something called Weight Watchers, where they get weighed in every week. And I said that's a really good idea, because in financial planning, a lot of people just set a goal and they don't look at it for months at a time. And by the time they do look at it, maybe they made the goal, maybe they didn't. But when you're looking at financial planning, it should be looked at on a periodic basis. I'm not saying you have to weigh in every week, but you certainly have to look at it periodically.
Okay. All right. What are you telling your clients right now? I mean, I know that they're all different, but I mean, you've got to be. Some people are expecting a dip here in the near term, and then it's a buying dip. Some people are moving into bonds or shorter term debt instruments because interest rates, as per the futures market, are looked to go higher over the course of time. I'd like to hear, what your thoughts are, because you're making decisions
this
here.
This week has been very interesting. I mean, we've seen a robust market, for the last however many months, and what we've been telling clients prior to this week was, let's reevaluate your expectations. because in 2017, you had high double-digit returns in the S&P and Dow, and many clients expected to have that same kind of return in a portfolio that was not exactly 100% invested in the S&P or the Dow. So we challenge the clients to re-examine their expectation, their goals, their risk tolerance, and if they want to have those same kind of, or mimic the same kind of returns as the quote-unquote the market, then they have to probably take a little bit more risk in their portfolio. Once we had that conversation with them, the overwhelming majority said no, they didn't want to take any more risk, and they're satisfied, which in many cases, it's hard to paint with a broad brush, but let's just take a moderate portfolio investor who might be 60% invested in equity, 40% in fixed income. They probably are going, for the most part, to stick with that asset allocation. And if the market continued to go up without any downturn, they would probably be a little disappointed in their decision. But this week alone, we're seeing what a turn in the market can do. And this is why you have asset allocation. This is why you have diversification. This is why you have everything that people tell you to do, other than put it all on red.
Got it. What are some of the high points of your book, that getting to the green?
Well, I think the highest point I can think of is golf is a microcosm of life. I mean, you can play around the golf with somebody, and within a very short period of time, you can get to know that person inside and out. But many of the same things that happen in golf happen in financial planning, happen in life in general. You have to start with knowing your strengths and weaknesses, your limitations. You start in all facets of life. You start with the basics. Good fundamentals always win. Developing strategies. Now, developing a strategy doesn't mean set the course and then put it on autopilot. It means set the course and then make changes periodically when need be. So, for example, in golf, you have some things that you can control and some things you can't control. I can't control the wind, but I can control whether or not I want to go over the pond in two. In financial planning, it's the same thing. I cannot control a 500-point day in the market, but I can control the type of investment choices that I make over long periods of time.
Got it. All right. Sound advice. We got about a minute left. Long-term, short-term goals. Anything in particular comes out right now?
Yeah, I mean, this is perfect timing for look, like I said, a day like today where you're down 500 points. Don't let short-term incidences influence your long-term goals. So if you have a long-term goal, stick with that plan, make adjustments periodically, but don't be influenced by the short-term razzle-dazzle of what happens in the market, whether it's up or down. I think it's important that you look at every day as it is, but you look at the overall long-term as your game plan for success. And it's the same thing. I mean, when you relate it to golf, I mean, your goal is to shoot X, whatever handicap you are, whatever X is, and just because you have one bad shot doesn't mean you give up the goal for that entire game.
Got it.
The market, financial planning is very similar.
Altair, we've got to run, but thank you so much for the interview.
It's my pleasure. Thank you so much.
My pleasure. Altair Gobo, author of Getting to the Green. Website is www.usfsc.com. We're going to take a short break right now. Segment brought to you by thevitaminpatch.com. You'll be listening to CEO Money with Michael Yorba. And up next, John Kosar, Chief Investment Strategist from